History shows that the best opportunities to get rich is during bear markets. This is the time when smart investors can see their returns activate hyperdrive and build wealth fast. 2022 is coming to an end, and we can conclude that 2022 has been a wide bear market. Most investment classes are down for the year. As of the recording of this video, S&P 500 is down 16%, bond indexes are down 15%, the housing market is on its way down, and crypto is bleeding red, with Bitcoin down over 60%. If you make the correct decisions during bear markets, you will end up as a wealthy person. But how should you invest during a bear market? What can history teach us from previous bear markets? Those are the questions we will answer in this video. Welcome to Investing in a Nutshell, the channel where we explain the world of investing so that you can learn and start your own journey as an investor. Let's start by defining what a bear market is. Economists define a bear market as a decline of 20% or more of a major stock market index, such as the S&P 500, for a sustained period. A bear market is the opposite of a bull market, a period marked by market gains of 20% or more. More broadly, you can use the term bear market for periods where the stock market declines and bull market for periods where the stock market gains value. With the definition above in mind, we can examine the history in the US. There have been 28 bear markets since 1928. The average decline was 35%, and the average length of the bear market was 289 days. The deepest bear market in history declined 62%, and the longest bear market lasted for 630 days, which is almost 2 years. Some of these bear markets were brutal, and many people have lost all their money, going from rich to poor in a very short time. But keep in mind that most of the bear markets don't last this long and don't go this deep. The previous bear market, which occurred at the start of the pandemic, only lasted for 33 days, and the market dropped 34%. But how can people make money in the stock market if there are so many deep bear markets? The answer is, of course, bull markets. There have been 16 bull markets since June 1932. The average length of a bull market is 3.8 years, with the longest bull market being the 11-year run from 2009 to 2020. On average, stocks gain 112% during a bull market. That's against an average loss of 35% during a bear market. And of course, stocks have only gone up over the long term. This is the key takeaway from bull and bear markets. The average bull market will last longer and increase more than the decrease of the bear market. Investments done during a bear market will typically make the investor very good returns the following 1, 3, and 5 years. Let's examine the last 3 bear markets and what would happen to a $10,000 investment in the S&P 500 after 1, 3, and 5 years. The most recent bear market was in March 2020. We can't calculate the 3 and 5 year performance since this has not yet occurred. But the first year achieved 75% returns, making your $10,000 investment increase to $17,478. We must dive back in time to find the previous bear market. It happened in 2009 and is known as the subprime mortgage crisis. If you had invested $10,000 in March 2009, you would see your money skyrocket to $16,863 the first year. The bull market kept delivering, and after 3 years, your money would be doubled to $20,266. After 5 years, the market had increased 277%, making your investment worth $27,766. Not bad. Let's examine one more bear market. At the start of the millennia, we had the dot-com bubble. If you had invested $10,000 in September 2002, it would rise 23% in 12 months. Not as much as the other 2 bull markets, but still not a bad year. After 3 years, you would have $14,835, and in September 2007, it would be worth $18,522. From history, we can see clear signs that the first years after a bear market provides great results. much higher than the average returns of the last 100 years. A smart investor should make sure to take advantage of the sale of stocks and buy the dip. To be fair, it is not possible to know the bottom of the bear market which we used in these examples. So how should a smart investor make investments in a bear market? We believe the answer is dollar cost averaging into a broad index like the S&P 500. We will cover dollar cost averaging in depth in a future video, so make sure to subscribe to the channel and press the like button. It really helps the channel and enables us to reach more people and help them start their investment journeys. In a nutshell, if you invest into a broad index every month, you will be able to take advantage of the cheap prices provided by the bear market. The average price will be low, and your returns should be high once we enter the coming bull market. This is the basic investment strategy that works well for most people. But remember to do your own research. This is not investment advice. If you want to achieve great results, this is historically a great strategy. But some of you will have more ambition and want to seek strategies with higher risk and a higher potential reward. We also have a strategy for you. During this particular bear market, some sectors have been punished harder than others. One of these sectors is the technology sector, including companies like Apple, Microsoft, Alphabet, Tesla, and Amazon. These are companies with solid financial statements, great growth, and a clear place in the future of humanity. The technology stocks are all part of the NASDAQ 100 index. One feasible way to invest would be to choose the NASDAQ 100 index instead of the S&P 500 index as your main investment. But can we do even better? Yes, but at a risk. For the advanced investor with a high risk tolerance, there are tools known as leveraging. Leveraging means borrowing money to increase your investments. There are a few popular choices for leveraging against the NASDAQ 100, and TQQQ by ProShares is perhaps the most popular. TQQQ is a 3x leverage index fund, tracking the NASDAQ 100. This means that a 10% increase in the NASDAQ 100 will lead to a 30% increase for TQQQ. This can be extremely powerful during a recovery in a bull market, but it is also dangerous if you can't handle great losses during bear markets. In 2022, it has been down more than 70%. An investment in TQQQ now, at the end of 2020, can provide very high return in 2023 if the bear market evolves into a bull market. But how high are we talking? Let's examine the last two bear markets for the NASDAQ 100. In 2018, the technology sector entered a bear market, sending TQQQ down almost 50%. If you had bought shares for $10,000 in December 2018, it would be worth $25,919 1 year later. An insane 259% return in just 1 year. The last recession from March 2020 sent TQQQ low, but it did not last long. A $10,000 investment would in 1 year turn into $48,693, almost 500% return in just 1 year. That is just insane. We can't understate the volatility and the risk associated with TQQQ, but the results from investments during a bull market is incredible. Even now, the investment made in March 2020 would be worth $24,000 after seeing a 60% drop year to date. Investments in recessions will historically lead to great results for investors who invest in broad indexes using dollar cost averaging. For this bear market, we see that the technology sector is punished a lot harder than the rest of the market. We believe this can be a great bargain and an opportunity for investors, and we have provided an alternative for those who seek high risk with high potential reward. But with all investments, it is important to do your own research and reach your own conclusions. To summarize the video in a sentence, we are going to use a quote from the investor legend Warren Buffett. Be fearful when others are greedy, and greedy when others are fearful. The time to invest is now, so go out there and find your way to make yourself a fortune. We hope you have enjoyed this video, and if you have any question or comment, we love your feedback. We read all your comments. Have a great day, and good luck on your own investment journey.